So we will be discussing December 2022 question number 1. I'm sure like all of you all must be having the question paper and the suggested solution, because that will be easier for us to take you through with the time allocation. So question one, you see the A part. It's about a corporate finance function plays a vital role in the economy, in any economy. Precisely, the corporate finance function is very important for the day-to-day running and development activities of an economy. The question asking us, discuss the role of the corporate finance function, discuss the role of the corporate finance function in the economic growth process of a country. So basically, the question is about the corporate finance function, and they are asking you, relevant to the economy, Sri Lanka or whatever country, what is the relevance the corporate finance function has to the economy of the country. So as you know that if you take any economy, the economic growth of the country, how do you measure? It's your GDP, right? Gross domestic product growth, you will be considering as the economic growth. So if you take previous year GDP and the current year GDP and you compare and see like the GDP has grown or it has contracted. So if you take last year, I think we had a negative growth, and then this year also it's been expected there will be a small or the 3% negative growth in the year. Maybe 2024 would be a positive growth for the country. So these are the expectations. So we should have an idea, okay, the growth is calculated or measured by comparing the last year GDP with the current year GDP. So they're asking, what is the role of the corporate finance function? So what we have to understand, the corporate finance involves certain activities, right? The corporate finance role. So the corporate finance involves, as we would have learned, the investment, financing, dividend. These three decisions are part and parcel of the corporate finance activities. So investment is about you deciding to invest in projects and any factory or equipment, land, building, all that fall into the investment. So the corporate finance activities, when you take its first activity is investment, then you are talking about how to finance the investments, where you would see like the sources of finance, there are various types of sources of finance. We all know that equity capital and debt capital are the two key ways of financing, but when you go in detail, you would see there are many subtypes of financing sources. So the sources of finance will give us the required capital. So the corporate finance activity involves creation of capital or raising of capital. It can be from the stock market, it can be from the debt market, or maybe from the banking circle. The monies you are going to raise for your investment from various sources. So that's a financing activity. Then the dividend, as you know, that even companies have annual or 2 dividends for a year. So that's basically the dividend decision. So these are the 3 activities involved in corporate finance function. So they are relating that to the economic growth. So how it happens? So firstly, if you look at any economy, for us to make investments, then money needs to be created or money needs to be collected over a period of time. So that is the first task, would be the savings. So each and every individual or a corporate or maybe a country as a whole, we start saving money. So that the saved money over a period of time, when it gets accumulated, could be used for investment. So it can be used for investment. So the savings will be converted to investment over the period. By the investments, to invest the money, the savings have to get converted into the the larger pool of money. So that is where you are raising the capital from the various sources. So I think if you look at the chapter 2 of the study pack, so one of the thing before discussing further, make sure that your study pack had been looked at properly before you go into the exam. Simple reason, because there are many areas the examiner is keen to see or check whether you have gone through the study pack material, because the study pack has enough material related to each and every topic. In addition to that, you get huge amount of examples, right? So please understand chapter 2 is talks about, I would say the chapter 2, 1.1, 1.3, all that is talking about this first 5 marks question. So simply if you read it, you will be able to answer what are activities in corporate finance and how it relates to the economic growth. So even any economy, if the people start saving money over a period of time, that money get accumulated and that get invested somewhere. So that investment basically is the capital formation. Capital formation. Okay, the capital formation will help definitely a growth of the country. Growth of the country. Okay, so that's basically the uh, corporate finance linkage to the economic growth, right? So I am not giving you an answer as such because it's a suggested answer as the answer, right? So great extent, if there anything I want to highlight from the suggested answer where you need to correct it, I will explain you. Otherwise, you could take it as a suggested answer is reasonable answer. At the same time, chapter 2 of the study pack, the couple of pages, first 2 pages will help you to answer this first part. Second, the B part, it's about a company buying fruits from local small growers and processes them to make fruit drinks. During the last 2 months, it's observed that demand for locally produced fruit drinks has increased and the processing capacity of the plant is not sufficient to cater to the increased demand. So they are giving that. And there are 2 comments. The chief executive officer of the company is of the opinion that the expansion should be funded through retained earnings since he believes that retained earnings is easy to access and comes free of any cost. However, the chief operating officer, he believes that debt financing is better. Debt financing is better to invest in any investment opportunity. So there are two sources of finance they are talking about. One is about retained earning, other one is about the loan, keeping the asset as a mortgage asset to borrow the money. The Roman number 1 of the B part, it says, as the chief financial officer of the company, evaluate the comments made by the CEO and COO. As the chief financial officer of the company, evaluate the comments made by the CEO and COO. So what do you think? There are 2 comments. One is by CEO and other one is from CFO. As we know that retained earning is the equity financing, is the portion of the equity of the company, that is the profits retained within the company. So it's available, as the CEO says, it's available easily. That means the monies are available in the company because the retained earning is with the company. You don't raise the money from outside market. So you are not going to raise from outside the company. You are going to use your own money. That's the retained earning. And he says that it comes free of cost. It has its limitation of meaning. The free of cost means to raise that money, you are not going to spend any money. That means you are not going to market, you are not going to broker, you are not going to do IPO or anything like that to raise the money. You are only using your own internal retained earning to invest in any project or any asset. But we, as knowledge of the financial management, we know that retained earning is part of the equity capital. Equity capital. So the question is whether equity has cost. Yes, definitely. It's called cost of equity. So the cost of equity is the cost of the shareholders' funds or the equity money. Equity money includes stated capital, retained earning, any other reserves. So the retained earning, when we say we have in a company, that money has definitely a cost. And we also know cost of equity is expensive than cost of debt. I'm sure all of you all know that cost of equity is definitely more than cost of debt. Simple reason being the risk involved for the investor of these 2 instruments are different. The investor who had put the money in the debt instrument takes lower risk compared to a person who has invested in the shares. So therefore, the investors expect a return in the debt component is cheaper or lower than the shareholders who put the money in the shares. So please note, therefore, the expected return of investor in debt instrument is cheaper than expected return in the share investment. On the other side, when the company uses the money, whether it's debt money or shareholder money, company, when they use it, that money has a cost. That cost is actually the expected return of the investor who has given the money. So on that way, cost of equity is always expensive than cost of debt. Cost of equity is expensive than cost of debt. So the CEO statement saying that retained earning is cheap cost, we should accept to the point that it is the easy accessible money, but does not mean it doesn't have cost. Definitely it has cost, which is called cost of equity, which is expensive than cost of debt. Cost of equity, which is expensive than cost of debt. So that's our comment for the CEO statement. Then when you move on to the chief operating officer of the opinion, the company should take a loan, keeping the new equipment to be acquired as collateral. So that when you look at the COO, chief operating officer statement, he says take the loan to invest and keep the mortgage. So now what we have to comment here is whether the CEO comment is correct or not correct. Is fine because he's saying like you use the debt capital to fund your investment. Now, whenever we are going to use debt capital, there are certain questions we should be asking ourselves. One, whether the return we get from the investment, is more than cost of debt. So the return on investment is more than cost of debt. So always remember, whenever we are using the debt capital to finance, whenever you are using debt capital to finance, the return on your investment should be more than cost of debt. As far as your return is more than cost of debt, definitely your debt capital can be raised for funding your investments. Second, the important thing in mind we should keep is even though return is more than cost of debt, if you are touched extreme gearing of a company, that is capital structure of your capital structure of a company, if you touch the extreme gearing, when I say extreme gearing, say 75% levels out of your total capital funding, say debt capital, you already use 75%. Then even if your return is more than cost of debt, ideally you should not go beyond that percentage of debt because that will be riskier for your company. So please note, whenever we are using debt capital, first thing we should be looking at it whether the return on investment is more than cost of debt. Why? The gearing objective is to increase the return to shareholders. So as far as your return is more than cost of debt, the extra return, if I say return on investment is 20% and cost of debt is 15%, so the 5% extra, who gets it? It's the shareholders who is going to get the return 5% extra because your return of the investment is more than cost of debt. So therefore, it's attractive for a company to use debt capital to finance the projects. However, you should not go beyond the extreme gearing level because that can be a disadvantage to the shareholders overall because the company can be running at a higher financial risk that can lead to your disaster. So please note that the debt capital when you are using, you have to be noting these two things. So the question is about whether the CEO statement is correct. CEO statement can be used or it can be agreed upon provided your conditions are met. But whenever we are going to use the debt capital, keeping the asset as a security, some other things to be remembered. What are things? You need to be careful whether you are able to repay your loan. Capital and interest, can you repay on a timely basis, monthly or quarterly or whatever? You are able to make that payment from your cash flow generation in your project. So if you can't meet those commitments on a monthly basis, you may be getting into a bad situation, or you may be getting a bad remark in your banking circle. So please be aware that whenever we are going to use debt capital, we need to be careful whether we are able to repay the capital and the interest on a monthly basis or regular basis. Second, when we give the security to borrow the money, always remember whether the company would be able to take your property or take your asset, or maybe they can go for parata execution. That chances are there always. So you need to be careful in you are going to take the debt capital, because if you don't plan properly your cash flow payments, in case you get into default situation, maybe your operation can get into a problem because the banks may stop your operation by selling the property, or they calling the company to sell the property because you are mortgaged the asset. So these are things to be remembered whenever we are using debt capital to finance the project. So it's more than the debt and equity capital comparison, it's how the company look at the business. If the company is a risk-taking company, they would prefer to use more debt capital because financial risk is represented by the debt capital. So the company may prefer to take more risk. Then company will say, okay, we will finance majority of the requirement by the debt capital. But if a company is little cautious or they are very conservative approach people, they would say like we will try much as possible to use the shareholders' money. But from financial management point of view, please be aware that the debt capital is a kind of a gift for you because it gives you a chance to earn more return for the shareholders, provided your ROI is more than cost of debt. So as far as you can earn return more than cost of debt, your shareholders will be definitely happy. So you have to be careful whenever we are using debt capital to finance a project. Then there are 3 marks question. They're asking about Roman number 2. Contrast the role of treasurer and the financial controller in an organization. Treasurer and the financial controller of an organization. So we should be, if anyone has gone through study pack, page 29, page 30, page 32, page 33. So page 29 to 33 study pack, if you go on through, it basically gives the roles of the treasurer and the financial controller. So treasurer mainly involves in raising money and investing money, right? So it's the major roles covers raising the money, investing the money, and the exchange rate, currency management, right? Liquidity management, all that falls into the treasurer role. So treasury department, most of the company have treasury department, so the investment division they call it. So they look after this raising of money and investing the money, and they manage the liquidity and the currency management. All that fall into the treasury department or the investment division. Financial controller role is the typical finance person's role, which includes your preparation of financial statements. It includes your compliance with standards, compliance with practices, policies, all that fall into that. So that's your finance statement preparation. Then your normal statutory compliances, making sure that your payments are made on time. It can be EPF, ETO, PAE, any taxes. All that falls under the financial control responsibilities. And your budget comparison or preparation of budget, and you compare with your actuals on a regular basis and see whether you're going beyond the budget. So the variance analysis, all that fall into the financial controller role. And the payroll management, that is basically processing the salaries of the staff. So these all are financial controller role. So please be aware that treasurer role is mostly relevant to the investment management, liquidity management, and the currency management, right? Includes investments and the borrowings. All are covered in that processes. Financial controllers, as I mentioned, those are the items. So financial controllers. So maybe the page 29 to 33 will help you. Just read it through. Even the suggested answer has the same answer. But even if you want, if you are, I'm just encouraging you to go through the study pack, because these questions you can see straight away from the study pack. So people who have just read these things would have got these marks and got through also. Okay, so that's basically Roman number 2. Then the C part of the question. Can we look at the C part of the question? Now, out of the 25 marks, I think the 15 marks is mainly coming from the theory, purely theory, straight away from study pack. So those still who are not started reading study pack for your exam, I appreciate that you start reading it, because there are a lot of expectation the examiner has from your study pack. Then the C part, it's about a company paid 150,000 as dividend during the current financial year. Due to challenging market conditions, the company does not expect to pay dividend for the next 2 years. And third year, it expects to pay 160,000 as dividends. So last year they paid 150. First 2 years, 1 and 2, they are not going to pay dividend. Third year, 160 as dividend. During the fourth and fifth year, dividends are expected to grow at 5% per annum. After that, dividends are expected to grow at 3% per annum. Consider shareholder rate of return of 20%. Compute the value of the company using dividend valuation model. So what is the model really relevant here? What is the dividend model we are looking at? The 2-stage, 3-stage dividend growth model. 2-stage, 3-stage dividend growth model. So basically, you should be knowing that I'm sharing you the answer, suggested answer, so that it's easy to understand. So you could see that dividends, year 1 and 2, no dividends are expected. Year 3, 160,000. Year 4, there is a 5% growth they're expecting. Year 4 is 5% growth you are expecting dividends. And year 4 and year 5, both are 5% growth they're expecting. Year 5 onwards, they're expecting 3% growth. So you could see there is a terminal value calculation. That is 1,068,776. It's the terminal value for year 6 onwards. Year 6 onwards, your cash flows present value. And recurrent rate of return, nothing that you have to worry, because examiner has given you the recurrent rate of return very clearly, 20%. So that's your discounting rate to discount your dividend cash flows. So as you know, the valuation principles, the cash flow based valuations have to be always done with present value of future cash flows. It can be dividend or free cash flow. In this question, it's about dividend. So present value of future dividend cash flows basically gives you the market value of the company. So as per the table, I think you can look at the suggested answer here, right? Year 2, 3, 4, year 3, year 4, year 5 dividends are shown there. And year 6 onwards, it is growing at 3%. So we have calculated the terminal value as 1,068,776. Then you discount at the rate of 20%. Then you get the market value of the company, 674,020. So that's basically the answer. So this is 6 marks. I think if you look at that, it's 25 marks, right? Those people who have read some notes about study pack, right? And people have some knowledge about valuation principle, definitely would get these marks. Then the Roman number 2, state 4 limitation of the dividend valuation model in estimating the value of a company. So when we use dividend valuation model, what are limitation you get? You should know that the growth rate, dividend growth rate, and the required rate of return, when you compare the dividend growth rate and the required rate of return, when you compare, your required rate of return should be more than dividend growth rate. Your growth rate has to be lower than the RRR. So that is one of the conditions. If you don't have it, you will see that your value become negative. Your value become negative. I'm sure, like all of you all know, no asset in the world could have a negative value. The lowest value any asset in the world could have is how much? 0 rupees. Okay, no asset in the world could have a negative value. In your balance sheet, your company net assets can be negative, but valuation principle does not recognize that. Valuation principle say your value of the company is minimum is how much? 0. So you don't have minus 100 million, minus 500 million negative net worth. Even if you say Sipetco, Ceylon Petroleum Corporation, or CEB, maybe a loss-making entity for a long period, so you will have negative net worth, but that doesn't mean they have no value. There is still the value is there for the company, some amount is there. So it's not accounting, financial management. Please understand, all the assets have a value. It does not have a negative value. So its lowest value could be 0. So the R minus G is one of the assumption you use in the dividend growth model. So the R has to be always more than G. Otherwise, your valuation doesn't work. So therefore, that is one of the limitation when you are using the dividend growth model. Then when we look at the 2-3 stages of dividend growth. Now in this question, they are talking about first 2 years no dividends, third and fourth year 5% growth, after 3% growth. Now how do you judge that? How do you judge that? So this is not easy thing. It's all forecast we are making. So the forecast what you are going to make may be correct, may not be correct. So the value what you are going to calculate is based on this forecast assumptions, which if it is not working, then the value is also not correct. So therefore, please be aware, the growth assumptions we are making is something always subjective or judgment. So that itself a limitation, because when we go to say the year 6 onwards, we are expecting the dividend to grow at 3%. Year 6 onwards to infinite period, your dividend is going to grow 3% per annum annually. Now that is a growth assumption you are making for a very long period. Now, how do you know whether it can be achieved or not? So that is what the limitation we are thinking, because when we use that valuation, this model to calculate value, the assumption if it is not going to work, then value is also not correct. Similarly, you are assuming 5% growth for third and fourth year. How do you know that? It's always an estimate only we are making. So that itself a limitation, because if that number changes, your value changes. So please understand that these are a few assumptions or the limitations whenever we use the dividend growth model in valuing a company. So that's basically your 4 marks Roman number 2. 4 marks Roman number 2. Right. So you could look at this is the answer. Right. Now we go to the question number 2. So when you read question number 2, it's about a company providing computer hardware items to its clients in Sri Lanka and currently evaluating whether to bid for a 3-year government project to supply wireless keyboards to a prestigious government department. And the company requires $60,000 at the beginning of the project to invest in high-tech machinery, which has an annual capacity of producing 20,000 wireless keyboards. So that's a capacity 20,000. Due to the depletion of the machine, the capacity can be utilized only in the first year, 100%. After that, the capacity comes down to 95 and 90% respectively for second and third year. Then the government department select company as a supplier, and supplier has to supply 15,200, 17,000, 13,200 wireless keyboards for the 3 years respectively. Any unused usable capacity could be sold to the local market in full. So please understand that whatever your capacity of production, that out of that you first supply to government department, and the balance whatever you have, you can sell it in the local market. And the bid price of a wireless keyboard is 10% less than the selling price to the local market. So please understand the government, we are going to supply 90% of the price which will be selling in the local market. So if I am selling the local market 1 rupee, I am selling to government at 90 cents. So 10% lesser. So that's I have an idea. Then the variable cost of the wireless keyboard is $1, and annual fixed cost including annual depreciation 22,800. So those are the cost details. Project requires $6,000 in year 0 as working capital, which could be realized at the end of the project life. So please note, the working capital investment you are making at always at a zero year, maybe 0 and 1 year some company or some projects, but here it's about 0 year, and that can be realized at the end of the project life. And we know that project is only for 3 years, so third year we can realize the investment that we make in working capital. Then they say the machinery depreciation on straight line basis over the project life, and the residual value of the high-tech machinery at the end of the project life is 9,600. So your $60,000 investment, the residual life value is 9,600. Capital allowance 25%, and the taxable tax rate 15%, and the required rate of return 15%. Board of directors inform the CFO of the company that if the SAP is going to bid for the project, the positive NPV of the project should be $3,000. Now, question: recommend a bid price for SAP and discuss the implications of setting the bid price. 15 marks. What is the area? I'm sure like all of you all must be having idea. What is the project? What is the question is asking about? Which chapter? It's about investor appraisal. Exactly. The project is about investor appraisal. So the question is asking, they are not asking you to evaluate the project and say project is positive NPV or negative NPV. The answer what you generally can get it from a project, NPV project or evaluation, they are already given, project appraisal. So when they are given you the NPV, how many NPV they want? What is the requirement of NPV? How much NPV they are expecting from this project? Can anyone say? Exactly, $3,000. So $3,000 is the NPV you want. So we know the answer what we want is $3,000. So what is the variable we want to calculate? What is the variable? What is the variable unknown here? Exactly, price. That's a question. 15 marks question is about recommend the bid price of SCP, discuss the implication of setting the bid price. So this is actually a what you call a project where they have given all the basic investor price information, and they are asking you to calculate the price at which you should be quoting your government bid in order to make NPV of $3,000. So that's basically the question. 15 marks. It's a bonus marks, I would say, because it's a very simple investment appraisal. Only thing you need to know that it's not just calculating NPV. They are given NPV. Backward you calculate to find out what is the price per unit. So can we have the suggested answer? So you could see that year 0, it's a 3-year project. The examiner is very, very kind enough to give you a project with a 3-year period, right? And very, very basic information. So I think when you look at it, you really know that these are the questions given to score marks, not the question number 3. Question number 3 has a lot of things to do. Question 1 and 2 is given for you to earn marks, provided you have a reasonable knowledge of your whatever knowledge you have gathered of each area. But definitely your marks are given there because the question is so simple. It's not so complicated because year 1 to 3 project, and you can put all the cash flow other than revenue. So you can see that $60,000 is year 0 investment, working capital investment $6,000 year 0, and it recovered year 3. Residual value $9,600. I'm referring to the suggested answer. Everyone must be having the copy of it, right? So you can see that initial investment $60,000 and working capital $6,000 investment year 0, and year 3 this is the last year of the project. You are recovering your working capital investment, which is 6,000. That's why we always say the working capital investment is a short-term investment or long-term investment. Working capital investment is a short-term investment or long-term investment. Anyone? Exactly. Working capital investment is a long-term investment. Working capital investment is long-term investment other than a portion of working capital investment you may make only for seasonal purpose. So if you're in Sri Lanka, April and December are the 2 holiday months where you get a festive season, right? So the people spend a lot. So in that case, if you are investing in your working capital, inventory or giving credit to debtors or having cash balance in your bank, all that is needed to be done only those 2 months. So if you are going to do that excess investment, that investment is not a long-term investment. Why? It is only kept only for a short period. After that, you basically recover that money into your cash flow. So please be aware, the investment in working capital is generally a long-term investment, but there is a portion which is called a variable component or temporary component, which has a nature of short-term investment. So in this case, they are very clearly said $6,000 you are investing year 0 and you are recovering 3-year end. Actually, examiner shouldn't have told that also. My thinking is that you shouldn't have been told that because it's understood that your investment in working capital year 0 generally get recovered at the end of the project. Unless the question clearly said that no recovery of working capital. So in that case, you don't get anything. Otherwise, you recover at the end of the project. So here they have said $6,000 investment recover at the end of the 3rd year. So on that basis, you can see that your investment appraisal, the cash flows are given, initial investment, working capital investment, residual value, which is clearly given, $9,600, you will be getting at the end of the project life. Then we come to the variable cost calculation, working number 1. Can you look at the working number 1? So you could see the working number 1. Machine capacity is 20,000. 20,000 is the machine capacity or the wireless keyboards. First year, the usable capacity 100%, second 95, third 90%. So you know the usable capacity number is 20,000, 19,000, 18,000 units. Then the government department and local market. So they are given the quantity we are going to sell to government department, which is given clearly 15,200, 17,000, 13,200. Then the local market. Out of 20,000, you sell the government, then balance is for local market, which is 4,800. Second year, your capacity is only 19,000. That means you produce only 19,000. Out of that, government you are supplying 17,000. So what is left for you to sell it in the local market is 2,000. Third year, it is 18,000 capacity, 13,200 supplying to government, 4,800 to local market. Then the price they are given there separately. Government price is 10% discounted. So if you say the government department discount is 10%, so if you say 1, it's X is your local price, local market price, and 90 cents. 90 cents is your government supplied price. Variable cost per unit, they are given $1. Variable cost per $1. So you can calculate that. Year 1, 15,200. Second year, 17,000. Third year, 13,200. That is to government supply. When you come to local market, 4,800, 2,000, 4,800. So anyway, $1 is variable cost per unit. So first year you are producing 20,000 units, so your variable cost is 20,000. Second year you're producing 19,000 units, so $19,000 is your variable cost for the second year. Third year, 18,000 you're producing, so 18,000 is your variable cost, because variable cost is for every unit produced, you have variable cost. So you could see that variable cost is given 20,000, 19,000, 18,000. So that's a working number 1. Working number 2, fixed cost. They are given clearly. What's your fixed cost going to be? Annual fixed cost, including annual depreciation, is 22,800. So please note, 22,800 is your annual fixed cost, but it includes depreciation. So we should take out the depreciation because it's not a cash flow item. So 22,800, you can see that the depreciation amount needs to be reduced. So how much your depreciation going to be? 16,800. Why? $60,000 is your initial investment, 60,000. Out of that, 9,600 can be recovered at the end of the project. So residual value. So how do you depreciate? 60,000 minus 9,600. That balance, 50,400, will have to be depreciated over the 3-year period. So accordingly, your annual depreciation is 16,800 that they have shown there, 16,800 for 3 years. So if your depreciation is 16,200 and your total fixed overhead is 22,800, how much is your cash fixed cost? Cash fixed cost, excluding depreciation. So out of 22,800, 16,800 depreciation. So 6,000 is your cash fixed cost. So that is your cash outflow you have to show in your investor appraisal, 6 million or 6,000 for year 1, 2, 3, $6,000. So you get your net cash flows. They have shown you net cash flows. And required rate of return is given at 15%. So they have got the present value of these cash flows. Present value of these cash flows. They are very clearly demarcating the present value calculation of the known cash flows. Known cash flows. So known cash flows present value calculation is done, and you are getting a present value of $113,035. $113,035, which is a minus present value. Now what we need is the revenue. But we need the revenue. As we know that the selling price, there are 2 prices. One is to government, we sell it at 1 rupee. Sorry, government we sell it at 90 cents, and the local market we sell it at $1. So we should be knowing not $1, if you take 1 rupee or whatever. So the basically calculation purposes, local price is more than the government supplied price. So they have shown that in the working, local price is 0.9x and the local market is X. Local market X and the government price is 0.9x. So they are now multiplying the unknown variable, which is X, which is basically your price. They basically showing W3, that is working 3, the sales 0.9x into 15,200 units to government plus X, it's a local price into 4,800 units for local market. So you get the 18,480x for year 1, your revenue. Then year 2, 17,300x, similar method. Third year, 16,680x. So these are all unknown variable, x. Then we should know that we need to calculate taxation because we didn't know the revenue earlier, so we didn't calculate taxation. That is working number 4. So you could see that the taxable profit they calculate from the revenue, they minus the cost 41,000. Then they calculate the taxation of 15% on the taxable profit. That working is also given there. So finally what they are getting is unknown variable, which is the price, which is X. If you say X is your price, what is the sales value? 18,480X for year 1. And your tax is going to be 2,772X minus 6,150. So please note, these are the unknown variable. So what they are doing is, they are going to now compare the known variable with unknown variable. So when you go down, go up, you could see that the net cash flows, they discount this unknown variable also. You can see here 1, 2, 3. Net cash flow is given there. There's a revenue cash flow working 3, taxation working 4, net cash flow is given in terms of X. Then you discount at the rate of 15%. Then you get your present value of revenue and the tax cash flow. Present value of revenue and tax cash flow. Then they know in order to accept this project, what is expected NPV we have $3,000. So your answer NPV, net present value, has to be $3,000. So we equate $3,000 to the known and unknown variable. Accordingly, the X, that is the selling price per unit in the local market, going to be almost $3. So at $3, if you sell it to the government, you would be able to get $3,000 NPV. Basically, that's the question. So just look at it on the other side. If the question has given you the $3 as your selling price and ask you calculate NPV of the project, that is the executive level 1. Executive level 1 question. If they are given you the X, that is the selling price to government is $3 and local market it is 90%. So $3 is your local market price and your government, you are going to sell it at 90% of that and calculate your NPV. So you would have done the calculation and got the answer as $3,000. But without doing that, the examiner asking you, given the NPV as $3,000, work backward and calculate what is the selling price per unit. So which is $3. Which is 15 marks. It's a 15 marks question, but it's very, 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 I would say easy question. Only thing, known and unknown variable, you should be aware. Then moving on to the B part of the question. B part of the question, can we have the yeah. B part, they say A Star Private Limited is planning to borrow 50 million from AST Bank for a 5-year period, and B Star is planning to borrow the same amount of money from ABC Bank for a similar period. So they both banks are going to borrow for 5 years. Both companies are going to borrow for 5 years, 50 million rupees. A Star has a higher credit rating than B Star. Both companies could borrow money at either at a fixed rate or floating rate. So they are given you the fixed rate and the floating rate. However, as per Asta prefers the floating rate for borrowing with the expectation of decreasing interest rate in the future. B Star prefers the fixed rate for the borrowing. So one is preferring floating rate, other one is preferring fixed rate. Question Roman number 1. Assess whether A Star and B Star could enter into a swap agreement. A star and B star could enter into a swap agreement. So it's about the area of which area? Interest rate risk management. Interest rate risk management. One of the technique to minimize your interest rate risk is the swap, interest rate swap transaction. So they are given you two companies, fixed and floating rates are given. Examiner asking first 2 marks whether these two company can get into a swap agreement. In order to get into a swap agreement, the swap agreement should get into or should give you a benefit for the arrangement. Otherwise, no one is going to get motivated to do a transaction. So how do we find out whether it's going to be a beneficial for the party? So that is where we want to find out how much is your gain, how much is your gain you can get it from the swap transaction. So this is called difference of difference. This calculation is called difference of differences. Difference of differences. How do you calculate? You compare the two company fixed rate difference, which is 2%, and two company floating rate, the difference is floating rate, fixed rate and floating rate, gap is 1.80. Oh, sorry, 80 cents, 80%, 0.80. So you have 2% fixed rate difference, floating rate you have 0.8. So the gap between these two, this is called difference of difference. Difference of difference, it's 1.2%. So this is a gain. This is a maximum gain you can make it from the swap transaction. So please note, if you see there is a gain from your swap transaction, then it's going to motivate for you to get into the transaction. So the gain you're going to get is 1.2%. 1.2%. Or from the Roman number 1 calculation point of view, your gain going to be 1.2%. So it basically gives you a inducement for you to get into the transaction. So shall we look at the suggested answer? So the fixed rate comparison, what I did here, right? So 1.2% is compared, difference of difference. So you get the difference between fixed rate and difference between the floating rate. So basically net amount is 1.2%. So that's the advantage of both parties getting into swap transaction. So that's basically the Roman number 1. Roman number 2. When you read the Roman number 2, can we read it, please? If the company AST Bank agrees to charge 0.1% as commission from each company, and A star requires an interest rate of 0.8. A star requires an interest rate of 0.8% as the net benefit. A star wants 0.8. Evaluate whether B star would be benefited by entering into this interest rate swap arrangement. So we know that 1.2%. 1.2% is the maximum gain. Please note, this is the maximum gain you can get it from the swap transaction. From the 1.2%, we have to pay the commission. And the commission amount going to be how much? How much the commission amount? Anyone? 0.1? No. How many commission amount? Total gain both party can get is 1.2%. Total commission how much? Exactly, 0.2%. So we know that total commission you get from the transaction or total commission you have to pay both party together is 0.2%. So 1.2% is your total gain. Out of that 0.2 you have to pay to the brokerage to the banks or the commission to the banks. So the net amount you get is how much? 0.2% when you minus, you're talking about 1%. So this is your net gain. This is the net gain we are going to get. So the net gain is 1%. Out of the net gain 1%, they mentioned that one bank or one party, A star, is having a better credit rating. A star has a higher credit rating. So why that information is given? The company which has a higher credit rating has a bargaining power to get a maximum gain compared to the other party. So even though the net gain is going to be 1%, ideally if both companies are equal size or equal bargaining power company, then 1% will be shared between the companies at 0.5, 0.5. But here we know that one party is powerful than the other party. And that party is requesting a net benefit of 0.8. So if the 1% is the net gain overall, and A star is going to get 0.8 and B star will get how much? 0.2%. Okay. So that's basically the gain carrying. So can you look at your Roman number 2 suggested answer? They show you the table. That's a swap transaction table. We generally start with the original contract. Then we have the terms. A pays B, B pays A. Then the commission to the bank, you deduct it. Commission to the bank, you can deduct it there or maybe later. It's not a issue there, right? You can leave it at the commission can be avoided, and then you can get the net gain from the both side party, how much you're going to get. Then you can take the commission. Because anyway, it's going to be 0.1% from both parties. So that's not something serious in your calculation, right? So you could see A star original contract with the bank. What nature of the contract they have entered into? A star. A star has got into a fixed contract. But what A star prefers? This is what you have to learn in the swap transaction. A star prefers what contract? What nature of contract? A star prefer what nature of contract? Anyone? Exactly. A star prefers variable and B star prefers fixed. But when we are going to do a swap transaction, the person who wants floating rate will get into the contract with the bank at what rate? What nature of contract? If A star is preferring floating rate, will they get into a floating rate contract with the bank or fixed rate with the bank? Fixed rate, exactly. So the opposite. So please note that you don't get into a contract with the bank what you wanted. If you are getting with the bank what you wanted, there is no swap. You don't want to swap the transaction. Because you wanted, you go and get the loan or maybe the contract with the bank, that's it. You don't want to share with somebody else. But since you are agreeing to share with somebody, you don't get into the bank contract what you wanted. You will go opposite. That means you will get into contract with the bank what the other party wanted. In that case, you wanted floating rate, but you get into the contract with the bank fixed contract. The B star, it's opposite of that. So that's basically the original contract. You can say 8% they are paying. B star pays LIBOR plus 1.8. And the A star pays B star is the same as the B star has paid the bank. Then the B star pays A stars. That is a backward calculation because we should know that our net gain using the swap will be A star will get 0.8 and B star will 0.2. So it's a bottom to top approach, 0.8, 0.2. First you put it and go backward and you calculate what is your term. That is 9.7%. B star will be paying to A star. That's basically the term of the transaction. So this is the kind of a interest rate swap arrangement. I think this is something the examiner has tested similar ways 3 times or at least 3 times in the last 10 papers. So it's not a new thing or difficult thing. It's the same as what has been done in the last 10 papers. So if you have done 10 papers at least, definitely this is bonus marks for you because it's very straightforward. 2 transaction they have given you and you can get the entire marks. I don't think anywhere you will lose the marks. It's very straightforward. It's not top to bottom because top to bottom questions are don't ask. Examiner don't ask it because it's very, very simple. So bottom top, that is where you know to find out what is the total gain you get and what is the net gain and how much each one is sharing. So backward you calculate the 0.8, 0.2 you put it net gain and backward you go up to 9.7 is the calculated number from the table because first 2 lines you can put it. First 2 lines you can original contract, you know how much the rate is. And A star pays B star, how much also you can know. So that all you can enter. B star pays A star, we don't know. We have to assume that one term we don't know. That's how you calculate. So on that way, we calculate 9.7 is the term you can pay. So finally, the 0.8 and 0.2 is the gain you are going to get. So that's basically the question number 2. Question number 2. Then we go to the question number 3, which is a case study question. I'm sure like all of you all would have watched the pre-scene discussion of this paper. I have done the pre-scene discussion for Sri Lanka in, I think, November, right? 2022. I have done that. It's in the YouTube channel, so you can watch it if you have not watched it. So that basically gives you the pre-scene discussion of the 2022 December paper. So you need to watch that when you are watching or when you are going through this paper. You have to watch that, otherwise you can't understand, right? Unless you have done your own pre-scene analysis, then it will be easier, right? But anyway, you watch that video because that is exactly the timing is before the exam. So that genuine pre-scene discussion, maybe certain information were not properly available at that point because it's a pre-scene, and we would have made some assumption and made the analysis. So now we have got the unseen, and then we have that paper is out and then all gone through. So the unseen material, when you look at it, you will have the idea about the pre-scene, what was discussed. So what I'm requesting you, if you are going to not watch the pre-scene of the 2022 December, please watch that, then look at it, because that will help you a lot to understand this question. Okay. So if you go to the straight away the question, no point in reading the whole thing, right? You can read the question straight away. So the A part, validate the doubts raised by Stephen on the liquidity position of the group for 2023 to meet operational and debt servicing expenses in light of the macroeconomic trends highlighted by the business success team. Support your answer with calculation and mention any assumptions you make. Assume that the same level of sales volume will be maintained for 2023. 9 marks. So it's basically about the unseen material part. Board meeting 1. So if you read the board meeting 1, you would see that actually this is the real life situation where our country went through a major challenges in terms of many front. The inflation was very high, right? They have examined has taken some 50% inflation, and the borrowing cost 10% incurred on long-term loan and leases. Now, please note, this is one thing I need to kind of make a change in my assumption of the pre-scene discussion in November. The lease, when we discussed in the pre-scene discussion, we took the leases outstanding in our balance sheet as the lease liability regarding the right to use asset. So that's the assumption I took when I did the November 2022 right of use assets. So when you take that assumption, we didn't consider the lease liability in our gearing calculation. Our gearing calculation in November 2020 pre-scene discussion, we excluded the leases because on the assumption this is part of your right of use asset. So it's not real interest bearing liability. It's not interest bearing liability. But when you look at the unseen material, the examiner says borrowing cost 10% incurred on long-term loan and the leases at present will go up by further 18%. So all of us know last year, 2020-22 period, Sri Lanka went through a very high inflation, almost close to the hyperinflation. We had the high inflation environment, and interest rates were very high, and which basically touched almost 30%, but in the example, or the examiner say 28%. So when he say 28%, he is accepting that it is relevant to loans and the leases. So what he is trying to say that your leases in your balance sheet is part of your debt capital. It's a part of debt capital. So please note, this is a difference or deviation from my pre-scene assumption in November to the unseen when I look at it. So unseen has given some information to change my assumption in the pre-scene level. Please understand that. Then the finance income for 22 would double in 2023 because the interest income also went up because the interest rates were going at double the numbers. Capital expenditure for 23 is almost the same as the depreciation. So this, when we read the line, we should know that there should be a reason why they want to say capital expenditure equal to depreciation. Just keep that in mind. Inventory levels of the group will increase by 25% beginning of the year to face inflation short supply. Except for inventories, assume that all other working capital would remain the same. So this is about a working capital investment for your free cash flow calculation. Marketing team estimated group revenue to increase by 48%. So please understand, most of the companies went through a very high sales for the year, mainly because not the volume increase, it's because the price increase. So here, even in this company, they say 48% increase in your sales because of the price increase of the production service of the group. Income tax estimated 500 million. It continued to increase 5% in perpetuity. Now the paragraph, which is relevant to the question. Stephen doubts whether the company could survive under these conditions and requested to carry out detailed analysis of the liquidity position of the group. So it's about liquidity area. In addition, the board of directors unanimously agreed that current business model does not seem right and they needed to analyze the current status of the profitability, efficiency of the assets used before taking any strategic move and take immediate action on worst performing business environment. The management also wishes to pay attention to the significant drop in profit caused by the minor drop in sales. So that's basically your Roman number 1, or the basically board meeting 1, which is relevant to your 9 marks question. Which is relevant to your 9 marks question. As I mentioned, you have to read your pre-scene or pre-scene, anyway you read, but you have to watch the pre-scene discussion of mine so that it will be easier, because otherwise you don't have time to look at all the ratios and go through the numbers. So the pre-scene has all the ratios calculation. So when you go to the suggested answer, so what they have done, they have taken the 22 P&L, they have taken 2022 P&L firstly, and 23 P&L they are forecasting by using the assumption given in board meeting 1. Firstly, revenue will be increasing at 48%. So they have taken 148% of your last year revenue. So that's very clear. Cost of sales, they have taken 50% more. So you can see that it's basically 50% more they have considered for your cost of sales on the assumption that your inflation is 50%, which is anyway given in the question. Inflationary impact is they are in the cost of sales. Then other income, again 50% they have taken increase. Then distribution, administration, other expenses, all they are taking 50% more than the last year on the assumption the inflationary impact is there for all the items. Then the profit from operating activity they are calculated. Then the fixed finance income, they have said finance income will be double. So it is 200%, which is 570 million. Finance cost. Now finance cost you need to calculate because your 10% finance cost become 28%. So working number 2. So can you look at the working number 2? Interest bearing loans and lease liability, which is from your pre-scene balance sheet. Pre-scene balance sheet, your interest bearing loans and lease liabilities. You can look at it. If anyone has not gone through the pre-scene, please go through a balance sheet of your pre-scene, which basically give you interest bearing liability, short and long term, plus the leases, together 35,348 or 35.3 billion. 23. Now what is 23? 23 interest bearing loan and liability, we don't know, but I think the examiner takes the assumption that your short term, that is current portion of your interest bearing and leases, will be paid in 2022. So, or 23 period. So 23 end, when you come to 23 end, you will have only a long term leases and interest bearing liability. So that is only 15,831. So the average liabilities, they are taking the average liability at 25.5 billion, and the interest rate, as I mentioned, 10% interest is now become 28%. So your finance cost is 7.1 billion. I believe that everyone can understand that. So 23, your interest bearing loan is assumed to be taken only the long term portion, because 23, when you look at your year end, you might not have your current portion which would have been paid. So they have taken on that assumption. So I think reasonable assumption, because otherwise there is no way that you can forecast your liability. Finance cost is 7165. Then you can see the changes in fair value of investment property that they assume, because it's insignificant amount, they assume the same number will be remaining. So they get you a profit before tax, 143 loss, and the tax is 500 million. They have given in the assumption in the board meeting 1. So your profit for the year 643. So this is just to get an idea about what is your P&L next year. Then we go to your working capital movement, working number 3. Your inventory 22 is given. And they have said 25% increase will be there in your working capital. That is 17,347. So changes in working capital is 3,470 or 3.4 billion. 3.4 billion you are investing in inventories. All other working capital item no change. So there will not be impact on your other items. And the loan repayment during the year, as I mentioned, current portion of your balance sheet interest-bearing loans and the leases are paid in the year. So the 19 million is paid during the year, the cash outflow. So the working 5 basically is talking about your profit from operating activities, changes in working capital, depreciation capital expenditure. Now, I mentioned the assumption your capital expenditure is assumed to be equal to depreciation. That means your net amount, capital expenditure you have to generally cash flow calculation, you minus, depreciation you add back. Here you add back and minus, both are same number. So net impact is 0. That's what they are showing. Depreciation and capital expenditure is 0. Free cash flow from before tax 2.9 billion. Tax payment 500 million. Net finance cost 7.1 billion, which we calculated earlier. Lease payment 19.5 billion. So net cash outflow 24.2 billion. And cash in hand 3.1. So finally, the free cash flow for 23 is going to be 21 billion minus. So based on the forecast of the company is going to get into serious cash flow problem because there is a shortage of 21 billion. 21 billion. Unless you plan properly, you are going to get into problem. So that is basically your 9-mark question. I think that's not so severe or difficult unless you have a problem in understanding the assumption. So if you are not making the assumption properly on 1 or 2 items, or we are not understanding the assumption that they are given properly, we may not be able to get to this cash flow calculation. So please understand the A part of the answer on the case study is simply we need to prove that company has a severe cash flow problem in the next year. So that we have shown 21 billion cash flow problem is going to be there for the company next year. Then the question number 2. Question number 2 or the B part. B part, can you read please? Segment performance for 2022 has been inconsistent and volatile for the group finance director. Write a report to the board of directors. Write a report to the board of directors with your critical evaluation of the segment performance of the group from profitability, efficiency, working capital. Now, I think if you all were watching the preceding discussion of mine in the previous past papers also, you would see that we always calculate 3 types of ratios: profitability, efficiency, not profitability, working capital, and the gearing. Here the examiner has included efficiency ratio also. So these ratios are calculated to understand the case. Now here, fortunately, what do you do at the pre-scene analysis level? The examiner wanted you to do that in the final answering. So it's easy for you because you would have done it by that time. So it's a matter of you just replacing it and then calculating the numbers or show the impact to the organization in terms of each segment. So here's a saying question: write a report to the board of directors with your critical evaluation of the segment performance from the profitability, working capital, efficiency. Ignore the other segment and mention only one key ratio under profitability and efficiency. So that also they are very, very limiting to say that you don't write all the ratio, whatever you know. Please use one profitability, one efficiency ratio. So it's a 13 marks. It's actually bonus marks because it's not so severe or difficult. It's basically what you have done in the pre-scene level. Right? You could see that the segmentation, which is given in the pre-scene as the segmentation. So you could see that GP ratio, sales, and the gross profit is compared to calculate GP for the retail segment and the distribution and the hotels. So you could see that the GP is calculated. I don't think anyone would have a problem because it's simply what you do have done at the pre-scene level. net profit ratio. Okay, but ratio to be used, it's your judgment call, right? Generally, the profitability ratios are, we generally say GP ratio and net profit margin, return on capital employed, and return on assets or return on capital employed, one of that you can use, and return on equity. So these are ratios generally we use at the profitability level. But sometimes the profitability level, we may not use the return on equity, because return on equity we will go to the shareholders' perspective calculation. So you can see the GP ratios are there for three segments. It's almost 10% all three segments. Net profit ratio, it is 1.8, 2%, 0.5. Return on capital employed, 12%, 7%, 10%. And return on assets, 3.2%, 0.82. Now what you are trying to say? When you look at the profitability of the segments, we know the retail segment is a key segment of the company, which also have 10% GP. Now, 10% GP is a small amount or large amount? That's the question. GP of 10% is a large amount or small amount? Because the company makes 1.8 billion profit, right, which has come down from last year 4 billion. So profit has dropped drastically, that we have known. So what I'm trying to say, the GP of 10% is a good GP amount, or it's not enough? Anyone? GP is not enough or enough? Not enough. Because generally you try to earn more in terms of GP. Maybe net profit margin can be low, but GP margin has to be higher so that you can manage all your expenses and stuff. So please note that one of the concern, the segments, all three segments, GP is not sufficient. We need to make a note to say that it's not sufficient for the company. Then in terms of net profit, obviously when the GP is lower, net profit is also lower. So it's automatic number, the final number. So that also doesn't show you very good return. Third, return on capital employed. Now please note, the return on capital employed, it is actually comparing your capital with your operating profit. The operating profit before financing. Which is telling you retained earning or retail segment, you earn 12%. And the other two segments, 7 and 10%. Now, what is your cost of equity? What is the return requirement of the shareholders? Because if you know that your shareholders are expecting return more than what you are earning from your operating profit, then it doesn't make sense. Your business is not going to make you a good return. So we should know that what is our shareholder return expectation. Okay, so when you go down, you will realize that what is your shareholder return expectation, or you look at the preceding discussion, the return expectation is very high, because we considered at that time, preceding discussion, we looked at the risk-free rate, very, very high rate at that time. So based on the high rate of risk-free rate, your shareholder require very high rate. Because those are 28% levels in the market, so you expect a higher return. So no business could give you a return compared to that market rate, because banks or government security, you may be able to invest and earn 25%, 30% return. And I don't think any business could be giving you the 30% or 35% return. So that is something abnormal situation. A country going through a bankruptcy levels of environment, you may not be able to see the variables reacting in a normal manner. These are all abnormal situations. So please be aware that the return what the company is getting 12% and the distribution segment 7% and the hotel segment 10%. Anyway, it's very lower. Even if there is no economic crisis in the country, 12% return from your operating profitability level is lower number, because definitely your bank would be giving you more return than 12%. So therefore, the return is not sufficient. That's the second observation. GP is very lower, and your return of the operating profitability also lower. Then moving on to the next level of ratios. Inventory days, you can see that 52 days, 71 days, 7 days. And debtors, 21 days, 54 days, 17 days. Now, these ratios, for us to comment, genuinely speaking, we should be having at least the industry information or the previous year's information. So without that, we should not be going to comment very much into this. But what we can see, the observation is whether you are carrying a large inventory or small inventory. So the examiner is basically mentioning that also. So the company is going to invest 25% more in the next year also. So the working capital investment is going to be higher than what we used to have. So that is going to be a problem for the company because company is already having a liquidity issues. I think the pre-scene, when you look at your pre-scene video, you will see that company has severe liquidity problem. Right? For your information, I can tell you the current ratio is less than 1, it's 0.8. Quick ratio is 0.41. Right? So at the pre-scene level, this was discussed. So 0.8 and 0.4. So quick ratio 0.4 means it's less than 1. To pay 1 rupee liability, even though you have liability of 1 rupee, your assets are only, or liquid assets are only 0.4, which is not enough to pay. So basically that shows that company is having a severe working capital issue. Even at the pre-scene level, we concluded that company is having a severe working capital issue. We don't need to come to unknown, what you call unseen material. At the pre-scene level itself, we realize that company is having a severe liquidity problem. The further question A part, we concluded that 2020 is going to be a tough year because 21 billion cash shortage, 21 billion cash shortage. So that's basically your observation for B part of the question. One is the profitability is not good, and second, your liquidity is not good. What we talked about, that's the working capital management side of it. Efficiency is for the debtors collection days and inventory holding period. As I mentioned, we may slightly mention about it, but then we don't have a comparison as to match. So we may not be able to tell exactly whether it's more or less. But general observation, we can see that company is taking how long to collect the money. 21 days to collect the money, convert the inventory into sales, 52 days. It may look larger in terms of the timing. Okay, so that's basically your B part. It's again just the analysis, financial analysis part. Now move on to C part of the question. Can you read the C part, please? So when you read the C part, comment on, it's a 20 marks. Out of your 50 marks, 40% of the marks is for the C part. So please read the question properly. By now you would have realized that still the question never asked about valuation chapter. Other than your question number 1, where the dividend valuation model was tested. Question 3 part, generally the case study question has the valuation area. So it's not there. Comment on whether you agree with the Stevens 4 viewpoints on the right issue and the opinion of the group finance director expressed during the board meeting 2 mentioned above. Board meeting 2. So can we go to the board meeting 2 firstly? So can you please read the board meeting 2? Group finance director explained that debt finance is too risky to bridge the next year's cash deficit. Instead, he came up with 2 alternatives, namely a right issue and selling off an existing business segment. So there are 2 ways they are recommending to bridge the cash flow issue. Rather than going to borrow money, they are saying that we go for right issue, that's an equity money, or we sell the one of the business segment. The group finance director is of the view that current market price of the company is heavily overvalued compared to earnings projections, and believe that this is the ideal time for a right issue. So this is the finance director's view. The best possible valuation per share is 17 rupees according to his calculation. So best possible valuation per share is 17 rupees according to his calculation. For discounted cash flow valuation purpose, group projects that the group free cash flow before tax reported for 2023 will increase by 30% for the next 5 years in anticipation of high inflation and will then settle at 5% thereafter for an infinite period. So the free cash flow calculation assumption is given there. Corporate tax is assumed to be 30%. Current capital structure is maintained throughout the lifetime. Current inflated long-term government bond rate 27% is expected to settle down to 15% within next 5 years. And the same trend is expected for cost of debt. Now, please remember your cost of debt at the moment, which is 17%, they assume that it will settle down in 5 years at 15%. However, Stephen is not in favor of right issue due to the following reason. These are the 4 points he is talking about in your C part. Current market price 32 rupees of the shares is undervalued. Hence, the right issue is not advisable. And the right issue is not advisable at this time. He estimates that fair value per share to be over 40 rupees. So according to Stephen, he said current market price 32 rupees, which is undervalued. According to finance director, we looked at earlier paragraph, he says shares are, anyone? Finance director says the shares are, anyone? According to finance director, shares are undervalued or overvalued? Exactly. According to finance director, shares are overvalued in the market. So he believes that his valuation says 17 rupees, but shares are overvalued in the market. So that means he is recommending for right issue. Whereas the Stephen, he says shares are undervalued. According to him, the shares are undervalued. Hence, the right issue is not advisable at this time. He estimates the fair value to be 40 rupees. Second point, right issue would dilute the company valuation and lead to a share price drop immediately. Third, right issue would dilute the existing shareholder ownership percentage in the company. Shareholder will generally have a negative sentiment on the right issue. Now, please note these 4 points, as per the Stephen, these 4 points are about right issue. So I think if you are very clear about your right issue theory, you get the entire marks, right? So those who have not been in the class, right, the video for equity financing for CA Sri Lanka I have done. So that has the right issue and the other share issue about the equity financing. That basically tells you about the right issue information. Anyway, we'll discuss this question. So basically, the question is asking, C part, comment on whether you agree with the Stevens 4 viewpoints on the right issue. That's the main part. Then the opinion of the group finance director expressed during the board meeting 2 mentioned above. So we know what is Stevens said, 4 points about the right issue, and Stevens says share is undervalued. Group finance director opinion is share is overvalued. Therefore, we should go for right issue. Support your answer with the appropriate calculation and explanation. Mention any assumption you make. 20 marks. Now, this is the valuation chapter, free cash flow based valuation question. Before going to number, shall we look at the 4 points of the Stephen? Can you read that 4 points again? Current market price 32 rupees. It's a current market price. 32 rupees of the company is undervalued. Hence, the right issue is not advisable at this juncture. He estimates the fair value per share is over 40 rupees. So we need to calculate the value of the company using free cash flow model and see whether 32 rupees is undervalued or overvalued. That is, we have to do separately calculation for the free cash flow. We leave that for time being. Second one, right issue would dilute the company's valuation and lead to a share price drop immediately. Can you understand that part? Right issue would dilute the company valuation and lead to a share price drop immediately. If you go back to your right issue knowledge, if a company go for right issue, what will happen to share price? Can I get the answer from you all? If the company go for right issue, what will happen to share price? Oh, let's put it. What is right issue? Anyone? What is right issue? Issuing shares to existing shareholders on a proportionate basis at a price what? Equal to market price, more than the market price, or less than the market price. Exactly. Very good. Less than the market price. So when we go for right issue and then issue the shares at a price which is less than the market price, after right issue, our overall share price, what will happen? Increase or reduce? If we go for exactly, I think you all may be knowing, right? If you know your theory, there is a calculation called what? Anyone? After the right issue, your share price will come down for sure. What do you call that price? Theoretical X-right price. Theoretical X-right price. TERP. TERP. This is theoretical X-right price. This is cheaper than your market price, what you add before the right issue. Why is that? Because if your company shares are trading at 100 rupees and you go for right issue at 80 rupees, after right issue, obviously your share price has to come down from 100 to lesser number, not 80. 100 to lesser than 100, but more than 80. So that's a theoretical X-right price calculation. So please note, the right issue will reduce your share price immediately. Why? Number of shares that you are giving in the market after right issue is more than earlier. Therefore, your price per share comes down. That is the immediate reaction. Does it mean your valuation of your company comes down? Can you answer that? Per share value comes down, true. But overall valuation of the company will come down? No. Exactly. It doesn't come down. It doesn't come down. So the dilution will not happen in terms of value because of the right issue. Per share value dilute, but not the total value of the company. Per share value will come down, not the dilution. It comes down in terms of value. Then they are talking about second one, right issue would dilute the existing shareholders' ownership. How many of you all believe that right issue will reduce your ownership? Can anyone answer that? Will the right issue reduce the ownership? I think at the final level, you don't have an answer saying yes or no. That we have to first learn. Right issue, will it dilute the ownership? Immediately everyone is saying no. What is the answer? If all the shareholders subscribe for the right issue, all the shareholders subscribe for the right issue, will there be a dilution or no dilution? If all the shareholders who are entitled to get the right issue and subscribe for the right issue, then no dilution. But if some of the shareholders don't subscribe for the right issue, then ownership get what happens? Dilution. Very good. So please understand, this is your theory. I'm just trying to tell you the theory because that is basically the requirement of your question. Because you have to challenge Stephen's view that ownership get diluted. So we need to say, look here, if the right issue is subscribed by everybody, all the shareholders, no dilution happens. No dilution happens. If there are some shareholders who don't subscribe, then the dilution happens. So the statement is not right. Right issue would dilute existing shareholder ownership. You need to say that right issue will dilute the ownership only if some shareholder don't subscribe. If all the shareholders subscribe, there is no dilution of ownership. The last one, shareholder will generally have negative sentiments on the right issue. Is it correct? Shareholders always have a negative sentiment on the right issue. Is it correct? No. Why? When you say you are going for right issue, you are giving the signal to the company shareholders saying that your company is expanding. Your company expanding. Because you don't just go to market and say, I want money. You say, okay, I am raising money as the right issue money with a purpose. One of the purpose could be expansion. You may say that you are going to put in the project, you're going to invest in factory, you're going to buy land, you're buying another company. So you are raising money to do that. So that gives the indication that your company is growing. It's a negative thing. Second, you might use the money to settle your borrowing. High interest rate borrowing, especially this company, the borrowing cost is higher. When the market rates are very high. So you may prefer to borrow. You take money from shareholder, settle some of the borrowing, because otherwise it's a huge amount of burden to the P&L. So please note, the shareholders have to be convinced to get the money from right issue. But at the same time, shareholder generally takes a positive approach unless the company has been mismanaged in the past. If there is no mismanagement in the past, they generally have a good positive attitude that when you are raising money, either you are raising money to invest in the money. If the company is unable to fully subscribe. Yeah, if the company is unable to fully subscribe, it's a negative thing. That is after the subscription, not at the beginning of the subscription. When the company announces I'm going for right issue in June month, when I mention that, there won't be a negative thinking. Only after right issue is subscribed, say June month we raise the money, there are majority of the shareholders don't subscribe. Then it's a negative sentiment. That is later, not at the beginning. So the C1 says that generally the shareholder would take a negative view on the right issue. It's not. They don't take a shareholder will generally have a negative sentiment on the right issue. It's not. It's wrong. It's wrong statement. Because generally the shareholder take a positive positive attitude on that, because they know that company raising money to invest the money for our benefit, or the company going to settle the borrowing in order to reduce the huge finance cost which is eating into our profits. So these are the two reasons when generally company take money from shareholder. Unless the company has a bad track record in the past where they have not managed your company properly and making losses continuously, and then they're going for right issue, no one will invest. No one will invest. So please be aware that the statement of C1, second one is wrong, third one is wrong, fourth one is wrong. All three we have commented. Wrong in the sense like there is a more argument to make from our side. Only first one we have not answered, that is about the valuation. So we come to that valuation story. So you have a table in the suggested answer. Can you look at the suggested answer? Please look at it. Net value as per the net asset value. Working number 7. So can we go to working number 7? Working number 7. You could see that your equity in your balance sheet of pre-seen material, your balance sheet equity 25.7 billion, 25.7 billion, and number of shares are given as 685 million. So net asset value per share 37.62, working number 7. So this is one of the methods, net asset based valuation. We generally don't use it, but for comparison purpose we have calculated. So your company net assets per share is 37 rupees. So please note, net assets itself 37 rupees. Then we go to the, before going to cash flow, shall I look at the PE method? Working 14. Can we go to the 14 working? 14. Profit after tax. Your P&L, pre-seen P&L 1,693. Earning per share 2.47. industry PE 10.61, value per share using PE method of valuation 26.21. If you watch my last year November pre-scene discussion, this calculation is already done. Right, net asset basis of valuation and the PE method of valuation we have done in the pre-scene level itself. So these are numbers even in the pre-scene video you would watch, you will see that. So 26.21 is your PE method of valuation. So we have got two method of valuation now. One is net assets 37.62 and the PE method of valuation 26.21. Then the market price per share, they are given 32 rupees. Market price per share is 32 rupees given by the company or examiner, 32 rupees. So we have got three values. Then now look at the discounted cash flow method, which is the significant one. This is calculation purposes or the marks purposes. It is working number 13, 16.57. We come to that. There are many workings you would have done. Okay, so we'll come to one by one. So even in the pre-scene discussion, if you watch it, we would have calculated our beta. From the beta, we have calculated the cost of equity in the pre-scene level. But the difference between the pre-scene discussion and the discussion now, the difference is pre-scene level, we were told the risk-free rate is 27%. So we calculated our cost of equity at the pre-scene level. If you watch the video, you would see that your cost of equity at the pre-scene level, is 29.55. That is on the assumption that your risk-free rate is 27% and your beta is 0.51. Therefore, your cost of equity is 29.55. But unseen, the examiner given additional information. He says that your risk-free rate at the moment is 27. True, agreed. But 5 years' time, your rate will be stabilized at what rate? Anyone? Today, your risk-free rate is 27. 5 years' time, your rate will be stabilizing at what rate? Exactly, 15%. So when we are going to look at a discounted cash flow method of the future cash flows, infinite cash flows, we are not going to use the today's rate only because that rate is going to change significantly, because more importantly, your today rate 27 is not a normal rate. It's an abnormal rate. Everyone knows that. Everyone knows that. Like inflation 50%, is it a normal inflation? No, it's abnormal inflation. Similarly, your 27% interest rate is not normal. So therefore, they have given you after 5 years, your rate going to be 15%. Therefore, your risk-free rate in working eight, you see that your risk-free rate is 27% plus 15% divided by 2. That means we are trying to get an average rate of risk-free, which is generally you don't need to do. Normal in any past paper case study question, we wouldn't have done that because there is no need, because your normal rates, what is given is something which could be there in the market for a long time. But this paper, your risk-free rate, what was given 27%, very abnormal rate in our history of Sri Lanka. So therefore, that rate cannot be sustained for long years. If it's sustained, no business can survive. As I mentioned, if you are going to get government security return of 27%, will there be any business to do? Because no business can give you 35-40% return. So it doesn't make sense. So therefore, please note, here the examiner clearly mentioned your risk-free rate 27% will stabilize at 15% in 5 years. So we take an average of that, which is 21%. It's assumption-based calculation, 21%. In that case, your cost of equity is going to be 23.55. Your cost of equity is 23.55, which is different from my pre-scene calculated number in November. Why? At that time, we had only risk-free rate of 27%. We don't have another rate to compare with. But examiner has given in unseen that 27 will stabilize at 15 in 5 years' time. So we take the average rate of 21%. 21%. On that, cost of equity is 23.55. Then cost of debt, again, 28% is our rate at the moment. But again, we are assuming that 5 years' time, the 15% gets stabilized. So average cost of debt going to be average of the 28 and 15, which is 22%, and tax rate is 30%. Then working nine shows that your cost of debt after tax is 15.4%. Now this is a very exceptional environment situation. Therefore, the examiner given you another rate of cost of debt and the risk-free rate in 5 years' time. Otherwise, generally we take the what is present cost of capital and what's cost of risk-free rate, and we take it for the whole period. Okay. Because if you take the 29% cost of equity and going to calculate your discounted cash flow, your project may not be worthwhile. Your future cash flow will not give you value. That's what you have to understand. Then the working 10 basically calculating the capital structure, which is based on your balance sheet, cost of equity, your equity capital and debt capital, and they calculate the weightage. As I mentioned, your debt capital includes a lease liability also, because it's an interest-bearing liability. It's not the right of use assets liability. It is the interest-bearing liability. So we calculate that also part of our debt capital. So equity and debt capital components are given 45 and 55. Cost of debt and cost of equity is given. Then they calculate the WACC, which is 19%. Only one thing, please remember, in this calculation, the WACC calculation, generally two things to be remembered. Anyone say, what are two things you to remember when you're calculating WACC? WACC, when you're calculating, two things to be remembered. Any idea? Zoom students? Cost of debt is before tax. Cost of debt is before tax or after tax? Cost of debt is always after tax. WACC, when you are computing, your cost of debt has to be after tax. One item is that. Second, your capital, equity or debt, both have to be book value or market value. Exactly, market value. So please remember that is something needs to be looked at whenever we calculating WACC. Not this question, any question. If you are going to calculate WACC, it has to be cost of debt has to be after tax, and your capital structure has to be market value based. But the examiner has used the market book value of the equity, even though there is a market price per share given by the question. Market price per share is given by the question. They have used the book value of equity and the book value of debt. So please make a note. If you are given the market value, your WACC calculation needs to be how? Whenever you are given the market value, your WACC calculation needs to be based on what? Book value or market value? Exactly, market value. So please note that. So that knowledge has to be there. So here they have used the book value, but ideally it should be market value based calculation. So your WACC, you know the standard format of calculating WACC. So 19%. Then you can see your free cash flow calculation, very simple calculation, because we calculated the free cash flow for 2023 earlier. So they take that amount, and from there they have considered the growth rate as per the question. How much the growth rate they mentioned? Free cash flow will be growing at what percentage? Anyone? They have said the free cash flow will be growing at what rate? Free cash flow will be growing at what rate? Anyone? No one. Free cash flow will be growing at what rate? Assumption given already. So you will see that group free cash flow before tax reported for 2000 would increase at 30% per annum for next 5 years. After that, settle down at 5%. So it is the board meeting 2 paragraph. Board meeting 2 paragraph. 5 years you will be growing at 30%. 5 years you are going to grow at 30%. After that, it will be settling down at 5%. So you can see that the free cash flow before tax working number 5, which is basically showing you the growth of 30% for 5 years. After that, your 5% growth. Income tax rate, again 500 million cash outflow, but that will grow by 5% for 5 years. So that's also given there. Then your terminal value calculation and WC calculation at 19% discounting. Present value, they got the enterprise value 43,596. 43,596 is your enterprise value. And you can see working 12 gives you a terminal value calculation. Then your debt is deducted from your enterprise value, because generally we know that your free cash flow firm will give you the market value of debt plus equity. From the market value debt plus equity, you minus the debt, So when you deduct the debt value, you get the market value equity, which is, in this case, they have added your cash balance, right? You have added the cash balance because they consider this as an entity value, enterprise value. So 11 million is equity value per share 16.57. Per share valuation as per their forecast 16.57. So we come back to the table that we looked at: 37 rupees, 16 rupees, 26 rupees, 32 rupees. Now, when you look at this table, can you tell me what is the more relevant price? Net assets say 37, that we know that's a minimum guaranteed value. Free cash flow gives you 16.7 or 16.6. P multiple 26, market price 32. Which is the more comprehensive method we generally consider? Which is a more comprehensive method? Out of valuation methods, which is the more comprehensive method? Exactly. Free cash flow method. Firstly, we look at the free cash flow method. So we should know that the free cash flow method is the more comprehensive method for any valuation. So on that way, we should know that the free cash flow method gives us 16 rupees is the price per share. Whereas according to question, they say the share is trading at 32 rupees. So share is overvalued or undervalued? Share is trading at 32 rupees and the discounted cash flow method valuation says 16 rupees. Share is undervalued or overvalued? Anyone? Exactly. I don't know why it takes so long. Overvalued. If your share price is 32 and your share is worth 16, shares in the market is overvalued. Who said shares is overvalued? Stephen or finance director? Finance director and Stephen, they made comments. Who basically said finance director or Stephen mentioned that shares are overvalued? Finance director, exactly. So please be aware that finance director, in that case, that value whatever we have calculated, that basically says that shares are already overvalued. In that case, according to his principle of going for right issue, it's worth it. Why? When the shares are overvalued, it's better that you get the money more to the company by share issue. You issue the same number of shares, but you get more money when you are having overvalued shares in the market. Okay, so basically that's the question. Basically, we answered, comment on whether you agree with the Stephen forward viewpoints. We agreed, we basically contradicted with the Stephen's views. Then the finance director view also we explained whether it's according to calculation, whether share is overvalued or undervalued. Okay. D part. Can you look at the D part? Discuss how you would strategize. And execute the power sector disposal in order to receive the maximum possible benefit to the group. Discuss how you would strategize and execute the power sector disposal in order to receive the maximum possible benefit to the group. So please understand that they are talking about two strategy. One is going for right issue, or other one is to one of the segment to be disposed. So here they are saying discuss how you would strategize and execute the power sector disposal in order to receive the maximum possible benefit of the group. In order to receive the maximum possible benefit of the group, 8 marks. So how do you do it? Dispose your power sector. Meeting number 3. Meeting number 3. Can you read the meeting number 3? So the company has received an offer from an existing player in the market to take over the long-term tangible assets, property, plant, equipment for an annual lease payment. The lease will be signed for a period of 25 years, commencing from 2023 with a zero terminal value. The first lease payment will be made in 2023, amounting to 300 million, and this will be increased by 5% per annum for the next 25 years. So basically, we are talking about 25-year lease. You're going to get the 25-year lease of the property, plant, equipment. So that is one of the way you can realize your investment in power sector. Then further they say the net realizable value. Net realizable value of property, plant, equipment is estimated to be 90% of its book value in the event it is disposed in the open market for retail buyer. So if you are going to sell the power sector, you can sell it for 90% of book value of the assets. Right of use assets and deferred tax asset will have a zero value if the power sector decides to discontinue operation. All other assets liability will be realized the book value. Power sector cost of capital 30%. So that's basically the information given. So now we need to calculate whether we should sell the power sector assets today or we should go for the long-term lease. So there are two options we have. Either we dispose the power sector assets today or you go for lease for 25 years. So when you move on to the suggested answer, so you can see that total assets 8.1 billion, power sector assets. Zero value items we have deduct. What are zero value items they are mentioned? There are two assets they have mentioned zero value item. One is right of use assets and deferred tax asset. Right of use assets and deferred tax asset you minus. So once you minus that, you have reduction in your PPE because you can't sell it at 100% of book value. Only 90% you can realize, 10% reduction. So that also you are deducting it. Then you guys realize the amount is 7.3 billion. Total amount of liability is 6.2 billion. Amount remained for shareholders 1 billion. So this is the 1 billion amount you are going to get by selling the assets today. If you are going to lease out your property, plant, equipment, what's going to happen? You are going to get your property, plant, equipment leased out for 25 years, right? So you will see that first lease payment is 300 million and it will increase by 5% for 25 years. For the next 25 years, it will be increased by 5%. So what's your present value of lease payment under the perpetuity assumption is 1.2 billion. That is, if you are talking about not 25 years, for the entire infinity period. So that's 1.2 billion. From that, you minus post 25 years cash flow. Then automatically you get the present value first 25 years. So they calculate your 25th year lease payment 968 and 2048, which is the 26th year lease payment, which is 1016. Then what they are doing is they are calculating the perpetual cash flows present value at the end of 2047. That is 4064 When you discount it, you get it at 6 million. So finally, the NPV, what is relevant to our lease rental is 1194. So you have comparison. 1194 is your present value of your lease payments or lease money what you're going to get, not payments, receipts, 1194. You compare with your disposal of your assets, 1059. So you decide which is beneficial to the company. Okay. So basically, this is the two options, right? You can look at the numbers, exactly calculation, it's in the suggested answer. But what the strategies we are to look at is there are two strategies. One is that you dispose the asset today. Other one, you are basically lease out the asset to somebody for longer period. So all the future cash flows present value needs to be compared with your today disposal value. That is what we did. So that basically gives us the answer for the last part. I think if you look at the December 2022, comparatively it's a easy paper, I would say, because your question 1 and 2, the 25 marks each, question 1 to 25 marks each, both are not that so difficult. Even the interest rate swap transaction, they are given very simple. And question 1, question 2, basically dividend valuation methods is straightforward. Question 1 also, you should know that it has an investment appraisal and your study pack chapter. Basically, if you have read the study pack, that marks is bonus marks. So the first 1 and 2 questions are really giving you marks to definitely score marks for your 50 marks target. Question 3 has its stories to say, but still the first two parts, I think the marks itself is 22 marks. One is about your liquidity related matter. That's basically whether you are having difficulty in your liquidity next year, 2023. Second one is about your profitability liquidity ratio calculation. So that is 22 marks question. So I'm sure like you could get some marks out of that part. And the last part, the disposal of the power sector asset, we definitely know there are two choices we have got. One is sell today or lease it out for 25 years. So you can calculate present value of 25 years, one, or you basically dispose today, very straightforward, and what is the value you get? You compare those two options. Only a C part has its comments to make because it's 20 marks question. Even out of 20 marks, the right issue related story, it's basically from your theory knowledge. You should be able to get the marks from there because they are asking about whether it dilutes the shareholder, dilutes the value of the company, whether it's a negative thing for the company. So those are marks you can score. Then comparing the value of the share. We have calculated net asset per share. We have calculated PE based share. This is a pre-seen level. We have done it. Only thing we are newly calculating is the free cash flow calculation. So that's the only part you are doing at the actually exam hall, newly, total fresh. Then you compare the values and see which is better. So please look at this 222 question paper. I'm sure like most of people must be feeling that you have a reasonable knowledge to answer the parts. Maybe you at the exam pressure at the time, in the exam hall, you may not be getting all the marks what I say, but definitely it gives you some confidence that it's not unknown area. The questions are known area and you can get some marks. You may not be getting the 20 out of 20, but you definitely get 12 out of 20 because it's something you know. Ratio calculation, you know how to calculate investment appraisal, known variable, unknown variable, you know. So interest rate swap also, it's very straightforward swap transaction. If you're done the past paper 10 papers, this question, you should get the marks. Difference calculation, net benefit, one party has a better rating than the other party. So those are very straightforward. So I believe that will give you some idea about this paper. Okay. So we'll be discussing the pre-seen your paper. I think Institute will be informing you through your email or maybe the website. They will mention you the date. So within a week or so, we will definitely do the pre-seen discussion. So all the very best for your participation. So please go through. I think that there will be a video. This video will be uploaded. So please watch the video and go through and see whether you understand what we discussed. Because I went on a presumption that you have read the pre-seen You watched the pre-seen video and you read the unseen material. On that assumption,